Good morning, Chair. I want to presentation about do accounting distortions measure earning quality, direction of dividend signaling. My introduction, earning quality in accounting refers to the ability of reported earnings to predict a company's future earnings. Peer literature has developed a number of earnings measures, partly due to the fact that there are a variety of earning management practices and that earnings management is difficult to detect. In order to measure accounting distortion, they follow the Richardson et al. 2006 models. Knowing about the relation of accounting distortion with accrual, they want to test if they will have the same result with the abnormal accrual. Another thing they want to test is the relation of accounting accruals with dividend signaling. The analysis using a sample of 1755 observations from 4 European countries. The results suggest that accounting distortions are not related with dividend signaling as abnormal accruals are. Furthermore, they found out that big leveraged companies have a small magnitude of accounting distortion, so their managers don't use earning multiplications. They try to combine accruals, distortion, dividends, and earning management. The next two chapters focus in understanding of this difficult definition, and as you will understand those variables. Okay, I will explain about definition of dividend signaling. Dividend signaling is a theory in economics that accompanies dividend announcement provide information about future earnings. Under this theory, if a company indicates that dividends will increase, this means it anticipates higher earnings in coming years. The results of their research have been mixed, indicating that while dividend signaling can be a predictive tool in some cases, in others it may more accurately reflect past economic developments. Companies use dividends to share profit with stockholders. Next, definition of dividend signaling. At the time officials make the decision to offer a dividend, they usually make an announcement providing information about the amount and date so shareholders know what to expect. If a company is not offering dividends, this could indicate that it is investing heavily with the goal of growing or that it is not doing well financially and cannot afford profit-sharing measures. Frequent high dividends can mean that a company is doing well, but could also be a warning sign that a company is not investing in new assets, maintenance, and growth activities. Some research does indicate that dividend signaling may be accurate, and some companies do indeed issue announcements for larger dividends when they are predicting large profits. Management may have access to inside information, causing an information asymmetry between management and stockholders. In economics and contract theory, information asymmetry deals with the study of decisions in transactions where one party has more or better information than the other. Next, definition of earning management. Earning management theoretically represents this gray area, but it is often used as synonym for earning manipulation or earning fraud. Companies use earnings management to smooth out fluctuation in earnings and to meet stock analyst earning projections. Large fluctuation in income and expense may be a normal part of a company operation, but the change may alarm investors prefer to see stability and growth, tempting managers to take advantage of accounting policy. Earning management involves the alteration of financial reports to mislead stakeholders about the organization's underlying performance or to influence contractual outcomes that depend on reported accounting numbers. Accrual accounting is the key tool used in the manipulation of reported earnings. Definition of earnings quality. Earning quality in accounting refers to the ability of reported earnings to predict a company's future earnings. It is an assessment criterion for our repeatable, controllable, and bangable. A verb's earning are, amongst other factors, and has variously been defined as the degree to which earning reflect underlying economic effects, are better estimates of cash flow, are conservative, or are predictable. For example, from the precision perspective, the quality of earning is high when earning precisely reflect the underlying operating risk and environment, business performance, and reporting quality of an entity. Okay, next, earning quality proxies have a unique factors. Unique combination of quality determinants and consequence. According to the accounting research literature, earning quality process might include the following: investor responsiveness to earnings and accounting methods auditor quality. In general, higher quality of earnings often helps companies to receive higher stock price, higher credit limits, lower interest rates, because there are so many dimensions of earnings quality. Market participants use various factors to estimate this quality. And next, definition of accruals. Accounts on a balance sheet that represent liabilities and non-cash based assets used in accrual-based accounting. This account include, among many others, account payable, account receivable, goodwill, future tax liability, and future interest expense. Accrual are adjustments for revenues that have been earned but are not yet recorded in accounts, and expenses that have been incurred but are not yet recorded in the account. That accrual need to be added via adjusting a try so that the financial statement report is in definition of accrual anomaly. The anomaly could be exploited by acquiring a long position in low accrual companies and a short position in high accrual companies. An explanation that has been offered for the accrual anomaly. The earnings fixation hypothesis held the investor fixed up upon earnings and failed to account separately to the cash flow and accrual components of earnings. Accounting distortion definitions. Accounting distortion refers to the situation where the information is not accordance with the output and causes fake information. Accounting distortion also means the form and provision of accounting information go against the principle of objective authenticity. It fails to reflect the real financial condition and business performance of accounting entities. It can also be divided into two types: intentional distortion and unintentional distortions. Accounting distortion can be seen as either an consequence of necessary rules regarding generally accepted accounting principles or a result of management's attempts to change the number to present a better financial picture of the accounting distortion definition. Accrual accounting bases have many benefits, such as this method has relevance than cash accounting bases, provide number of accounting timely. Many causes of distortion are accounting standard, estimate some number by manager or earning management, and the manipulation of accrual accounting can increase manager bonus and compensation. Solution to accounting distortion: you can see establishing accounting regulation, and at the same time we should also establish unit in financial accounting system as well as the system of accounting methods for flies. Solution to accounting distortions: they should also complement and perfect the accounting laws and regulation, make sure that a regulatory department and the enterprise as a legal person from the legal accountability, establishing the contract-based principle agent relation between the manager and the board of directors, establishing the external restraint mechanism and fully performing the function of the intermediary institution. The accounting supervision system of our country consists of the said supervision. Abnormal accruals in is this paper, firm total accrual divide assets and minus firm normal accruals. Abnormal accruals measure of capturing discretionary accrual behavior or a measure of total. Difference between abnormal accrual and accounting distortion. Abnormal accrual are very similar to accounting distortion. Both of them are used on firm earning manipulation, although abnormal accruals have some limitations. Literature review. Extensive work has been made by Pesnet et al. Who explain specification and power issues relating to the measurement of an abnormal accrual or using cross-sectional estimation procedure and futuristic. I'm formally comparing the power of alternative estimation procedures and alternative accrual definitions will therefore represent an interesting contribution. If earning management via revenue or bad debt account is anticipated, then the standard Jones and modified Jones models appear to offer the greatest chance of detecting it. Alternatively, if expand manipulation is anticipated, then the margin model may be more. Okay. Invike WorldCom continued to pay dividends during the period that it was accused of accounting fraud. This anecdote suggests that although dividend payment reduces managerial incentive to manipulate earnings and the future result, you can examine when and how the other incentives such as executive compensation, capital issuance, and pressures from stakeholders affect the signaling of dividends about quality of reported accounts and others. Research. Mikkel et al. Contributed to the literature by examining the market reaction and analysis response to dividend changes. They found that controlling for the magnitude of a firm's dividend change its information environment. They also find that controlling for the magnitude of the dividend change the firm's information environment and the release of other information between forecast revision. Data and variable measures. Our sample consists of firm-level and country-level data that are obtained from DataStream International. The sample covered the following European countries and measurement of firm-level variables in the 9 variables: 1 operating assets, number 2 operating liabilities, and 3 net operating assets, or accounting distortion, formula net sales or revenue, number 5 new dividend yield, number 6 firm size, 7 leverage, and 8 growth is calculated as the natural log of net sales or revenue. And number 9, H is the firm as measured by the number of shares that the company's stock price that are available. Methodology. Van Hill, Leland, Ng, Natalia Zaid, and Bozan, 2012. In this article, the variable construction start with measurement of earning quality. Then others in Jones' model, 1991, total accrual includes changes in working capital and depreciation expense, assuming that changes in working capital are function of revenue growth. And Stu and Francis, 2005, extended the Cho and the Chef model, adding sales growth to public performance results. Empirical result. First, dividend payers have significantly smaller abnormal accruals and higher accruals quality than non-payers. This suggests that the average abnormal accruals and non-dividend payers is more than half larger than those of payers. On the other hand, positive relation of abnormal accruals on reported earnings implicate that abnormal accruals inflate. In conclusion, the primary objective of our paper was to examine if accounting distortions respond the same way as abnormal accruals. From our empirical result, they found out that accounting distortions are not related with dividends as abnormal accruals do. This result that accounting distortion is completely different measure of earning quality significantly related to growth. A limitation to our study is that they didn't test dividend as a control variable to see if the statistically insignificance will change with accounting distortions, but this could be a good idea for future studies. Another idea for future research is to study other accrual types like aggregate accruals, which are the dominant component of a company's earning. When reversing tends to occur more quickly and earning with a high accrual component can be considered lower high quality. Okay, this is my presentation for Aziz Hammer in my investment and fintech application. Thank you for your attention and good afternoon.